Joining me now with more is Luke Tilley, Chief Economist at Wilmington Trust. Luke, it is great to have you on the show this morning. And as we prepare for this trifecta of jobs data this week, what is your expectation?
Yeah, Kristen, thanks for having me on. We do think that the jobs data that you just described is the most important thing that's going to be driving markets in the short term and those Federal Reserve reactions, because what we see is a little bit of a risk of a slowdown. We've had about 5 months where all the jobs reports have been impacted by the storms and the Boeing strike, really pushing down job gains in 1 month, and then they surge back in reaction the next month. But if you look through that at a 6-month average, the 6-month monthly job gains are in the 140s per month. But of particular note is that the private job gains are 108,000 average per month over the past 6 months. And we see that as a downside risk because we know that the job openings have been falling quite a bit since 2022. As you said, we'll find out more in a little bit less than an hour. And that really signals weakening labor demand by firms, possibly because demand for their products is weakening a little bit, but also because maybe they're using AI instead of workers. So that's sort of the way that AI cuts both ways. We're expecting jobs to slow down to about 130,000 per month, and that includes the government jobs. So that's still pretty much on the low side. And the unemployment rate probably stay where it is at 4.2, maybe tick up to 4.3. But more importantly, we expect it to rise more than the Fed does and more than consensus does. We expect it to rise to 4.7 over the course of this year. We think that'll end up leading to more Fed rate cuts than are currently priced into markets, Kristen.
Luke, of course, we are keenly focused on the economy as well as announcements coming out of the Consumer Electronics Show. Technology has driven many of the gains that we've seen in the overall indexes like the S&P 500. How does the technology economy look to you?
Technology economy looks really strong. We really think it is helping to drive markets. Of course, some of those big tech companies have been the biggest drivers of gains in large cap, as you noted. We've also had some broadening of performance, which is encouraging. We are concerned a little bit as we release our outlook for 2025 right now. We describe the economy and the markets as a chutes and ladders economy, both for the economy and for markets. There are various things that could look like that old board game where they could carry you up a ladder in the economy and the markets could do quite well. And then there's also chutes that could knock you down a few spaces. And as much as we love tech and as much as we love that long-term story, one of the things that we're looking at is the possibility that valuations being so high are really priced to perfection. And we're just cautious and very conscious that any guidance that comes, earnings reports from some of the tech companies could lead to some pessimism there. So we don't have a pessimistic outlook, but we do note that those valuations indicate that things are priced for perfection. We're watching for any sort of chinks in the armor there, if you will, Kristen.
Luke, another factor, of course, that investors have been digesting this week is somewhat mixed messages on tariffs, but a positive report yesterday. At least that's how market participants perceived it. We had seen a Washington Post report that the president-elect Donald Trump was considering narrowing tariffs as opposed to huge tariffs, which he proposed along the campaign trail. Of course, then later on, he took to his platform of choice, Truth Social, and said that Washington Post report was not true, and we saw markets respond to that a bit. How are you planning for that as we await his inauguration on January 20th?
Yeah, it's a great question, Kristen. It's one of the things that we're watching most closely. We've actually noted tariffs as one of the possible chutes, as a lot of investors are worried about, but also one of the ladders. On the chutes side, we know that the proposed tariffs on the campaign trail would raise the overall effective tariff rate, for the U.S. Imports to 19% or so. That would be the highest since the 1930s, which was, of course, an incredibly protectionist time. Now, we don't think it's going to come out at those levels, despite what President-elect said on Truth Social yesterday. We think that there will be a lot of bargaining, but we do expect some of those tariffs, and that could cause some challenges depending on the level that they come in at, and depending if they are across all countries or if there are special deals, could lead to some of those chutes that we talk about, which cause some problems for the economy and markets. The ladders on the upside could be, I think that President Trump in his first term, we need to recognize that NAFTA 2.0 or the USMCA was a good outcome we think, when it comes to tariffs and using them as a bargaining tool. And it really could help get some of our largest companies and some of our drivers of the indexes access to more markets worldwide, help some efficiencies, decrease some regulation. So it could be a boon as well. And frankly, Kristen, I don't think anybody really knows how it's going to turn out. So we're just going to have to be watching that closely as it progresses.
As earnings season will be here before we know it, including with some of these big banks kicking that off, what are your expectations, Luke?
Yeah, earnings season, we expect it to be pretty solid. Without digging too much into the details, but one of the things that we are watching out for is, as I mentioned, both with tech companies, but anybody across the board, are some of the chinks in the armor there. We have noted, especially as the Economist, I pay particularly close attention to some of those consumer companies and consumer discretionary companies. We're looking for any notes that consumers could be weakening, or is looking to see if they are solid, to see if consumers can keep powering the economy ahead. We expect the GDP growth rate to slow to 1.8% this year. That would be the slowest since the pandemic. It's still pretty solid. And a lot of that is coming from the consumer, which we expect to slow down, but still remain pretty solid. So we're looking to those consumer discretionary companies to get some insight into that.
Luke Tilley, Chief Economist at Wilmington Trust. Luke, thank you so much for joining.
Thanks for having me.